much stronger in terms of the companies who apply to the program, because the companies I see now, a lot of them, I think, make sense. The question on some of them will be, well, is it sort of big enough? Is it sort of, would I invest based on the product, the team, the vision, the market, and so on and so forth? It's funny that this year a couple of Techstars companies actually compete with some of my companies, which is kind of interesting. They were trying to, okay, so in that case, what do you guys do? Which kind of, okay.
It's not
one
on
said,
purpose.
we're going to crush them. I like the cockiness, not too much though. So I think it's the funnel must be better because the companies, I think, are stronger. So I'm not sure whether they will all succeed. They will all build something sort of big, but there's a bunch of interesting business innovation which is happening thanks to this crazy architecture which has been built over the past few years in terms of enablement, in terms of distribution. And the Techstars batch of this year is sort of a good example of a bunch of vertical businesses that will be successful, just not clear as to how big companies they will end up.
Mm-hmm. And of course,
whereas in the past they were like, well, I'm not sure it's going to work at all.
No
Yeah.
Oh, well, that's good to know. There are about 3,000 companies a year trying to get into Techstars now, so certainly.
And by the way, I was impressed by the New York batch, which for first year was actually pretty strong.
Yeah, it was a good group. Of course, there are other programs out there that look like Techstars now. We started the Techstars Network to try to help some of them, but by our last count, there were about 130 globally that were sort of startup accelerators, short-term, small funding, mentorship-driven. In your view as investors, is that a good thing for you or a bad thing for you?
So anything that supports entrepreneurs and entrepreneurship is a good thing. The thing which I'm concerned about very often is when I look at the mentor community surrounding those companies, and I don't feel that they have had essentially the failures and the experience that makes them sort of good mentors, I'm concerned. Because if you do one startup and you're lucky and you have a good 3-year run and you have a nice $20 million exit, that's great, but you're not experienced. You've seen one thing. And so sometimes I have a feeling that it's too easy to start an incubator. And so personally, I pay a lot of attention to Techstars, obviously, to Y Combinator, which started it all, and to Seed Camp. And that's it. I'm always open to try and help people, time permitting. So I'm not going to fly around the country to sort of spend time with everyone. But I'm just concerned about the quality of the mentors, and rather see a concentrated force supporting less programs and maybe less entrepreneurs, but with better results than things we try to spread really very broadly, and where the quality is therefore sort of questionable.
So I have a little different point of view, but it's interesting and instructive in terms of how we thought about Techstars as well, because from the very beginning, after the first year that David ran Techstars here in Boulder, he had 30, 40 people from around the country say, hey, can we do a Techstars City X?
Yeah.
And we're very deliberate in year 2. David came and we sat and sort of talked about, okay, what's the plan for the next year? Should we expand geographically? Should we do another program? And my response was, let's do exactly what we just did again. Like, we did a really good job. Let's make sure we've got it nailed. And year 2 was better than year 1. Year 1 was great. Year 2 was better. There were some things that we learned from year 1 and year 2. And the same thing happened. Tons of inbound. Now it's 50, can we do this? And there were a few that had started to pop up, and the response to those few that had started to pop up whenever they approached us was, we just open sourced our approach. We said, here's our documents, here's how we do it. We spent time with them. I think we were mentors for a handful of them, went and spent time at a few of them to try to help, them understand what we do. And frankly, from our standpoint, also to learn how other people were thinking about it, to make sure we were thinking about it as broadly as possible. When Techstars expanded geographically to Boston, it got pulled to Boston by the Boston community. Bill Warner, who was a successful entrepreneur, said, this has to be in Boston. When it went to Seattle, same thing. Andy Sack and Greg Gottesman pulled it to Seattle. We want to do this in Seattle. And those were cities that I think the expansion was deliberate from a pull perspective. New York was a little more deliberate. We sort of stepped back and said, where else do we want something like this? And New York was a totally obvious place.
Absolutely.
in that context, I think we've tried really hard to help anybody that wants to start something like this in any city get it up and going, recognizing that we can probably help increase their probability of success through exactly what you just described, right? Guys, here are some things you have to do if you want to do this. You have to have high quality mentors. You have to play a multi-year game. You have to have sort of this notion that the mentor engagement is critical to these entrepreneurs. You have to recognize that a lot of things are not going to work. You have to have a funding model that's sustainable versus a funding model that's a one-year grant from your city, right? A bunch of very specific things. And I think when I look at the evolution of Techstars Network, which is now 25, 30 organizations out of the couple of hundred around the world, even within those 30, there's a spectrum. Some are great, some are okay, some are struggling to figure out what they're doing. And the message I give anybody sort of in the world of trying to create an accelerator, or entrepreneurs who are trying to engage in their own entrepreneurial communities, is to recognize that it is a multi-year, multi-experience, right? Multi-time experience. Like many of the companies that go through these accelerators are going to fail. And that is just part of the experience of being an entrepreneur. In the same way that of your 103 companies, it'd be great if 103 of them were successful, but that's a nice fantasy. That's not going to happen. Of the companies we invest in, not all of them are successful. The companies that go through Techstars, 70% or so have gotten financing, 30% or so have sort of gone nowhere. But of the 70% that get financing, not 100% of those will ultimately be successful. And I think that message has to keep getting out, because I think the mistake, when I sort of look back at a time frame where things got out of control in 2000, 2001, there wasn't this sense that anything could fail, or that anything would ever fail. Like anything you do would work. And so what happens is everybody sort of comes in expecting it's going to be easy, it's going to work, it's not going to be a big deal. And this shit is just hard. And as long as sort of the whole chain understands that, it's powerful. So I think we've tried to make sure that people understand that as we talk about it.
I think that there's a set of me which really supports this, but the other is, we've heard some horror stories of entrepreneurs moving to, go to attend some programs that were not properly funded, and those guys ended up, stuck there. I mean, there has been sort of a few unfortunate examples of excess,
and there will be more,
but which is why I think it's, and you guys sort of can't control that, because the what you want to do, which is through the open sourcing, is to really foster as many programs as possible. It's just say, hey, make sure you have a solid base, make sure you have people who are really fully committed, because you can't drive entrepreneurs to failure because of the program itself.
Right. There are an awful lot who don't have those parameters, those things that you talked about. The 25 or so that are in the network, there's 50 or so that we just didn't feel like they were at that level and they were going to put on a great program. So I think you do have to be careful of that.
The other piece of that, which is true even for established programs, is a sort of expectation mismatch. I think we tried really hard, and part of the ability to do it well within Techstars is that each program only has 10 companies, maybe 11. New York has 12, that go through it. But it's
12 this year. Right.
It's a bounded number. Right, and so by that number being bounded, you're in a position where you don't end up with a group of people that have a mismatch in terms of what they're going to get out of it, what it's going to look like, et cetera. I think that lots of other geographic programs, that expectation mismatch is blurry because there's not the same level of experience. What am I going to get? The accelerator shouldn't oversell what they're going to be providing until they have a track record of actually providing that. And I think that's a challenge in the mix as well.
Cool. We're gonna take a quick break. I want to come back. We're gonna bring in an entrepreneur, because that's what we want to do on this show. Want to get some real feedback for a real entrepreneur who's been through some stuff. Take a quick break. We'll be right back with Ari Newman of FilterBox. Okay, and we're back. We're joined by Ari Newman, who's the founder of FilterBox, which was a Techstars company from 2007. On This Week in Techstars, we want to talk about real issues that real entrepreneurs have dealt with. Tell us a little bit about FilterBox circa 2007, when you joined the first ever Techstars program.
Well, it was all about trying to solve the information overload problem. I was doing a lot of blogging and was constantly subscribing to more and more feeds, and sort of realized that I had a filter problem, hence the name FilterBox. The options available were like Google Alerts and 50K a month, and there was nothing in between. So it became obvious very quickly that business professionals, people that were socially networked, people that were active in early social media, needed a better way to keep a pulse of the web. And there were a lot of other services that I liked, things like, at the time, 37 Signals from a project management standpoint, where sort of the freemium model of delivering something to the SMB space for productivity to make your life better and make technology work for you made a lot of sense.
So I want to set up an issue to talk about, let you kind of frame it, but I remember during Techstars and for maybe a year or so that followed, a lot of the discussion was about the focus of which customers in the market were we really going after and what were the pricing issues. So can you just set that up and tell us a little bit about what you were thinking about back then?
Yeah, I mean, the whole thing was an experiment. So the approach we took was we really wanted to understand where our customers were, and they may have been big companies and little companies, but clearly we wanted to have a business relationship with an individual. So to us, the freemium model made a lot of sense, and we weren't clear as to where the customers were in terms of a vertical or horizontal segment. We just knew that if you're a busy business professional and your options were subscribing to feeds and then clicking, mark as read for 7,000 items a day, you probably were looking for something better, and we wanted to develop a relationship with those people and figure it out from there.
Your pricing, if I remember early on, is very much set up around a single user inside a company or maybe a few users, and really targeted more SMB than enterprise, although you're getting a little bit of demand from both.
Yeah.
You had a lot of competitors in the enterprise level. Was the initial goal to sort of go after the smaller businesses by design?
Yeah, I mean, the whole strategy was to go after the gap in the market, right? If you looked at something like Google Alerts, and then you looked at some of these enterprise like news clipping services, there was nothing in between, and there was a huge a huge opportunity to deliver something of value somewhere in between. There was sort of a continuum of pricing that we didn't fully understand, but the feedback that we got at the low end, hey, how does $20 a month for this awesome service sound? Great, I'll sign up. Right? So that's where we started.
But I'm sure you guys as investors see a lot of companies that start off maybe with a low price product. I've seen several that sort of move up market eventually. Mm-hmm. How do you think about that dynamic? How do you coach an entrepreneur like Ari to sort of think about that and figure out the right approach?
So I'll take a crack at it first. And I remember a conversation very vividly when I was driving to Keystone and I stopped for gas and we were talking, and you were really struggling with trying to go after a broad swath of users at a low price point, or go at a much higher price point after a much more narrow use case.
Right.
And you had started with this sort of broad swath of users, and you were having a lot of trouble getting to a place where you had enough volume across that broad swath of users.
Yeah.
So I think and that was the discussion we're having. So should you dump that low end user base and focus on a much higher user base? Should you figure out that segmentation better? And one of the challenges is if you don't have a built-in scale dynamic in your pricing model, it's very, very hard to shift people from a low user price to a higher user price. If you have a scale dynamic where you have valuable service across some level that you can get users in at a relatively low price point, and they get fundamental value at that low price point, and it has a very, very wide market adoption. But when they step up the volume meaningfully, there's a much higher price point as they ramp. That's very interesting. And I think you were really struggling with how do I get to that, that ramp up where the value of the user starts to become meaningful.
Right. Well, so as we're going through this week, we were realizing two really important things. One was at the end of the day, what we needed were consumer web app game dynamics at play in a B2B product in order to get that viral adoption, right? The whole invite your colleagues, refer a friend, share a filter or a monitor with somebody, get more people to sign up, 2 people become 5 people, become an office full of people buying. We were, with limited resources and the accelerated timeline we had, we certainly were not fully investing in that feature set and not doing extensive A and B testing to figure out whether it was value based in terms of more filters for your dollar, or feature based, which was advanced analytics or social collaboration. So we were struggling with all of those things while at the same time going through this process of trying to figure this out as to really where was the customer, right? So I remember one day, like I was riding my bike home from work. It was 10 p.m. right, and I sort of had this moment where I was like, oh bleep, like we either have.
Is it fuck or shit?
Well, probably shit,
okay.
Right? Oh shit.
Hey, there could be people that are offended by that kind of language watching this show.
And so I sort of had this oh shit moment where I was like, I might be going to market as a B2B solution, but I need to start thinking, living and breathing consumer if I'm going to do this. I need to think lowest common denominator. I need to simplify the app. I need to completely change the messaging. And this was the sort of moment where we realized we had to make some pretty hard decisions, because that viral, organic, just sort of happens growth where people just convert at a certain rate, and all you have to do is get more people through the front door in order to see the business scale. Like, the platform just wasn't set up for that.
We hear a lot of times, Jeff, maybe you could comment on this. I know you've seen it, this $20 to $100 price point, like really tough to live in that range. What kind of companies can do it? What kind of companies shouldn't do it?
Well, it's kind of interesting, because typically you will start with an initial set of customers who will pay you something, and they will almost self-select and say, hey, I'll pay up to X, and you will take that. And then you will figure out that you could acquire a bunch of customers at that scale, but it's going to be just impossible to build a big company there. And so you're going to try and segment the product, and sometimes you will actually have to shut the door on your initial customers, the one who paid you the $20 to $100, to get to $2,000 to $10,000.
You reading my board packages?
I think I've gotten that email from Filterbox, actually.
And I'm thinking about this company where basically we had a freemium approach, and we literally wiped out the entire free part so that everyone becomes a high value customer. And because it's a high touch product, you can't just do a self-serve. And so sometimes you figure out where to go on the basis of what you learn with the initial sort of island of customers to which you say goodbye to. And that's okay.
I'd add to that I think there's a lot of value early on, and I think you started thinking about this. And I remember a conversation, I think it was at the Techstars reunion in Seattle, when we had that lunch at that sushi place that we went to. Remember that?
Right.
Where the conversation evolved into, there's a lot of value in defining who your customer isn't. And a lot of times in a business, as you're struggling with the segmentation, you start from this frame of reference of how can I capture as many customers as possible.
The answer is no.
You end up sort of thinking about it upside down.
Right.
If you define it as who is not my customer, okay, what's left? Is that interesting? No, that's not interesting. Okay, try again. That's a different process. And you sort of came at it from, let me try to capture as many customers as I can. And then over time started shifting to, well, there's a whole bunch of these customers that are never going to pay for it. They're never going to have a return on investment on those customers. Why should I be spending time on them?
So there's something else. I think at that phase in the evolution too, we maybe made another mistake, which was trying to monetize those customers too early, right? Yep. So, I could make the argument that we were trying to monetize a customer base we didn't fully understand yet. So we were kind of running a lot of micro experiments, which isn't always bad, but had we maybe waited for more data or really gotten to a point where who the customer was obvious before we fully went after monetization, the hockey stick could have been a lot steeper.
I have a good example for that. Is I'm an investor in a company in Seattle called Big Door. That you're an investor in as well. And
are you allowed to plug your investments on the show?
It's our show. We can do whatever the hell we want.
Just saying.
Shut me down. Good luck, baby. And
how about some SendGrid now? No.
We did that already. SendGrid's wonderful. But let's get back to Big Door. So Big Door has this compelling vision and has built this infrastructure for gamifying all kinds of different web applications, and it can be as simple as gamifying, a blog, all the way up to sort of very complex sites. Major League Baseball just rolled out a big deployment with them where they actually gamify the experience of participating and watching Major League Baseball games. Pretty cool. A little self-referential, but pretty cool. And they started off with a pricing model that was a usage-based pricing model. And so you got it free up to a certain amount of API calls, and above a certain amount of API calls, you started paying per API call, and there was a curve. And the problem was that it was too complicated to understand the pricing curve for these very early adopter customers. And frankly, it wasn't clear where the value dynamic was. And it was clear that there was value, but it wasn't clear what that value point was. And so we spent a lot of time and said, this is the wrong approach. Let's make the usage of this completely free. Because the actual API infrastructure is a cost structure that we can manage. What we're really trying to get to is a virtual economy around each of these publishers. And if we can successfully create a virtual economy around these publishers, there's plenty of money in the system to be able to figure out where to go from there.
Yep.
What they've done is they've spent the last, maybe 6-9 months since that decision, building and deploying with a number of high-end, high-value publishers. Very, very deep integrations, and they've learned an enormous amount. They provided a ton of value for those publishers for free, but they've also learned an enormous amount about where the layers of value are, where the real upside is. So it's not always that, there's a lot of pressure to, generate some revenue, let's make some money, let's figure it out. In some cases, it's much better, as you said, to sort of step back and say, let me make sure I understand what value I'm actually providing here.
Wind the clock forward 5 years. What did you guys ultimately do? Obviously, the world's very different today, but
right. I mean, so Jeff was actually alluding to it, right? So what he described, it was almost verbatim to what we did. So everyone said,
not knowing, by the way,
right? But I mean, you sort of read the play exactly. So everyone said, the cliche that everyone says is, lowering your prices is easy, raising your prices is hard, and that can be true for a number of reasons. But to fast forward, basically, we learned really quickly, hey, the customer is in a couple of these segments. They were either marketers, they were PR folks working at agencies. Occasionally, they were like sole proprietors or small business executives. A lot of other startups and people generally in tech and marketing and PR that were fed up paying outrageous prices for crappy products. And they found us because we were written up on a blog or social media, or someone recommended us, or so on and so forth. Now, what we learned was, in order to actually close them, we needed to give them a demo so they understood the power of the platform. And once you got on the phone with them, it usually took 1 or 2 additional touches to close the deal. So it was like 6 weeks after we really started looking at that data that we realized this is not a zero-touch, self-convert model, and we can close almost as many deals as we can get our hands on. But the economics obviously don't work at the $10 or $20 a month price point. We also then very quickly started to do some experimentation on the phone when we started quoting people. And this new product that we were rolling out, the G2 product, we just started quoting people at $100 a month instead of $20 a month. And instead of getting a negative reaction, we got even more interest, right? So 6-8 weeks later, we execute the pivot. We basically drop freemium from the website. We start listing at $100 a month starting price point, all inside sales model. We hire 2 more people, and revenue starts to take off from there.
Yep. Sort of the paradox that it's not a toy anymore. You have to pay a little more for it, and you're maybe paying $10,000 a month, and you take it more seriously.
Absolutely, and that's the issue of a lot of services where if the price point is isn't high enough, it's not a serious decision, it's too easy, and then people don't feel sort of involved in it, and so they will drop out, they will churn, and will be sort of not a good customer for you guys.
Right. Now, one of the key things was that to the Techstars mantra of doing more faster. We had launched the G2 version of our product right around this time. So we weren't just selling the same old product. Not that you can't get away with that, but we weren't just selling the same old product, at almost at a 10x. We also had the launch of the G2 product as part of the story. So we would show people the old product and show them what people were paying, and then the new one at the new price point. And it was pretty easy value prop.
So from there things started to work great. Obviously today you're part of Jive. You guys were acquired last year. How's life in the big corporate company?
Well, at 400 people, I guess compared to my 13-person company, it feels pretty big. But life is good. I mean, Jive's an amazing company, and The filter box technology is fully baked into the platform now. In fact, we're just launching Jive 5 very shortly here, and we've built yet another brand new version of this thing, so it's fully embedded and being delivered to the enterprise users. So, ironically, you come full circle, and now the technology that we originally built, that we were selling on a per user basis, is now getting sold, organization wide to large companies, so they can take advantage of the social web. So it's been good to see it come around completely.
Yeah, I think we talk a lot about second order effects with Techstars, and you're now a very active mentor in the program. Jive is here in town. Some really amazing things have come out of this, and so I just want to thank you guys all. You've been here from the beginning. You were in the first program. You guys have been mentors since day one and very involved. So thanks for joining us today on This Week in Techstars.
On the very first one.
That's right, the premiere. Hope everybody enjoyed it. Want to give another shout out to SendGrid for sponsoring the show. And thanks again to Michael Sidorzeski of Callisto FM. You should check out his startup, very awesome. He set up the studio, makes all this magic work. We'll see you next week on This Week in Techstars.